there are plenty of stocks that perform well over the years that maybe aren't as exciting as the Nvidias, the Apples, the Googles, the Mag 7s of the world. Those stocks are like, okay, we got AI, we got technology, are we going to go 100% this year, right? Those are exciting. I like those stocks. I cover them on this channel. But today we're going to be looking at some stocks that maybe aren't as exciting, we could say it like that, but are going to perform well over the long term. Of course, no guarantees, but these stocks all have a track record of performing well, are at relatively cheap prices, right? And American Express is the first one we're looking at today, up 143% over the last 5 years. That is a good performance. S&P 500 is only up 90% over the last 5 years, so you're outperforming the S&P 500 and pretty significantly. The dividend's about the same, so let's call it a wash there. And then PE ratio is also lower. 22 PE ratio, S&P 500 PE ratio is about 30 right now. So you have a significant discount with upside, more upside than the S&P 500, meaning you've performed better as of recent. If we go back to late 2015, early 2015, late 2014, you're up from about 80. So you've performed well over this time frame as well. S&P 500 is only up about 200%, so you're outperforming there as well. I like how the chart's gone, but we'll ignore that. And we'll look at the forward PE, which is what's more important. Also, forward PE 20. So S&P 500, forward PE is 23. So you are cheaper on the PE metric, on the forward PE metric, and you've outperformed. Also, credit card companies just perform well, and they perform consistently well. Visa, MasterCard are two other companies that are very good. However, those are a bit more expensive in terms of PE, and they haven't performed quite as well over the last 5 years. So that's why we're looking at American Express today, but all three of those companies are good, have performed well. It's not like Americans are going to be spending less on credit cards anytime soon. So all three of those companies are good. But our next one we're looking at is Lowe's, and Home Depot kind of fits into this category as well. Lowe's is also cheaper at 21 PE, which is why we're looking at it today. It's up 100%. However, you have to factor in the dividend is higher than the S&P 500, so you're getting some upside there as well. Also, this has been a terrible home building market for the last, basically since 2021, since inflation peaked, rates have gone up. You can't borrow money as well. People are not getting mortgages, or if they are, they're not ideal. So it's just been a terrible, terrible home building market. They've still outperformed the S&P 500. If we zoom out, it looks even better. Since early 2015, they're up from about 74 to 250. That is good. That's over 300%. You're really liking the performance there. Like I said earlier, S&P 500 is only at about 200% over the last 5 years. So forward PE, you're also lower. Yeah, you're not expecting to grow as much next year. However, the year after that, if growth is better than people think, well, they don't really look forward 2 years. Stocks are kind of blind to that, but not completely blind. But next year's not going to grow crazy well, but even then, you're still cheaper than the S&P 500. So if you start growing at rates you would expect to, this is going to be a company that's going to do very well. And already, like I said, has a track record of performing very well. The last one we're looking at, the chart is gone again, 81% over the last 5 years, waste management. It's not super sexy. However, this is a company, if you zoom out, it's just up and up and up and up. Basically, I don't know, since 2000, you could go basically any time on this chart. It peaked a little bit in 2007, right? And then went a little bit down in 2009. But it really isn't that noticeable, and it's just up and up and up and up. This is a company, they basically do, believe it or not, waste management. Wow, shocking. But yeah, they performed just under S&P 500 over the last 5 years, but it's really not that much under. Forward dividend is good, and like I said, if we look since 2015, you're doing a bit better. Early 2015, late 2014, you're up from 50, so you're up 400% or so. Is that 300% for? I don't know, off the top of my head. But either way, you're outperforming the S&P 500 over the last 10 years. This is a company that, like I said, isn't maybe going to be as sexy. It's maybe not going to go up 300% a year or something. These guys have relative ceilings. If you were to buy something like Vertiv, which I've covered on this channel, and they keep doing as well as they have over the next 5 years, you can go up maybe 500% or something. These companies are very, very likely not to do that. However, they have been consistent performers over a long time period. They're in stable-ish industries, and like I said, they perform well. And this waste management's maybe the quote-unquote worst one, in the sense that it's underperformed slightly, and its valuation is right around S&P 500. But all these are relatively cheap, boring-ish good performing stocks over a long time period. So anyways, I hope all of you enjoyed watching this video. If you did, please like and subscribe. I do daily stock content on this channel, and I appreciate all of you for watching.